This one person waiting. Okay, this done. Share screen. Okay. This is where we were. Okay, then, happy Saturday morning, and let's continue with our discussion on corporate finance. We started our discussion by saying uh, people go into business for many reasons, but if you look at the financial objectives of a firm in economic terms means a business entity. But for us, a firm will mean listed company. Yeah. So if people go into business and they are a small business, a non-listed business, at a very basic level, every business from the smallest to the biggest, their objective is of course to earn surplus income. Yeah, and that's profit. But if you go beyond that, then it's not enough that businesses just generate profit in a specific given period. Um, they should also be able to generate income and profits on a consistent basis. Now, the ability of a business to generate income and profits on a consistent basis is called profitability. Yeah? And we saw last night, we measure profitability by looking at the rate of revenue generation, margins, and returns. Yeah? So, of course, as students of corporate finance, we need to understand uh, what is margin, what is return. Margin is profits compared to revenue. So when you're working out a margin, you want to know how much of profit you can squeeze out of every dollar of sales that you make. When you're talking about returns, you are answering the core question that any good business person should ask, and that is, if I put in $1 in this business, how many cents return do I get? Yeah. And then, of course, beyond that, listed companies have a more sophisticated objective, and that is to build the shareholder value. Yeah. And today we will start our discussion with how that can happen. Yeah. Now, in shareholder value, there are two components: risk management and healthy cash flow. So actually, point 3 and 4 are part of shareholder value. And then, of course, nowadays I suggested to you that there is also a move towards companies wanting to be socially responsible entities, and so they will talk in terms of CSR, triple bottom line, six capitals model, so on and so forth. Yeah. We did a quick review of the important parts of financial statements, and we said the three most important statements are the statement of profit or loss, statement of financial position, and of course the cash flow statement. Yeah. And now we are therefore in a position to continue our discussion on shareholder value. Yeah, there you go. So, like I said just now, shareholder value has two key components. The first component is the ability of the company to sustain future cash flow surplus. Please notice that when you talk about profit, you are talking profit in terms of accounting. When you're talking about profitability, you're using accounting information to work out the rate at which profits are generated. But when you come to shareholder value, then it is based on cash flow. Yeah, actual cash flow. So what is the cash flow surplus that can be generated by this business in each year for the foreseeable future? And then the other thing you need to know is what would be the required rate of return from present and potential investors. So actually the formula for shareholder value, if I may just start off with that. So I hope you have your notepads with you, and today you will need some calculators to be next to you as well. So shareholder value is simply future cash flow per annum and the underlying assumption is that this should be sustainable divided by required rate of return, which is sometimes referred to as the cost of capital for listed companies. Yeah? So that's it, that's the formula. Now, future cash flows, of course, we will talk about how we can have sustainable future cash flows. Required return, the cost of capital, is basically the required return on long-term investment by people who are already invested in the listed company or who will come in and invest. Yeah. So to give you a very simple example, if we take the projected cash flows per annum from three companies, company A, B, and C, and the risk profile of company A is that it's a low risk company. They do very safe kind of business. They have many contracts in hand already. We used to say, well, if they work for government agencies, that's pretty safe. But nowadays, governments are not safe. We can't really say that much anymore. But if a company's business profile is relatively of low risk, then you find that the required return will also be lower. Yeah. If the required return goes up from 10% to 12% under the same business scenario, that would mean that company B's cash flows have somewhat higher risk. Yeah? And then company C, if it is considered to be high risk, the required return would be 20%. So later this morning, we will see how we compute this required return, yeah? Which is called cost of capital. So cost of capital simply means the cost of using long-term money for a listed company. Yeah, and because we said that the formula is projected cash flows divided by required return. Divided here is of course what we are doing mathematically, but conceptually we are actually discounting the cash flows. You might remember from your earlier studies, if you want to work out the present value of a perpetuity, yeah, present value of a perpetuity is equal to annual cash flow divided by R, the required rate of return. That's the present value of perpetuity. Yeah? So that is why we got shareholder value as future cash flow per annum divided by A0. Yeah? It's derived from here. Okay, so let us say that the projected cash flows, the cash flow surplus from each company is more or less the same. And since today is the 19th, let us say it is 19,000, 19 million, yeah? 19, 19, and 19. All three entities tend to give more or less the same return. Or to make it even more exciting, maybe we say entity C promises much higher returns of 25 million cash flow surplus per annum. So the question will be, what is the shareholder value? And so for all intents and purposes, you might say shareholder value is the value at which new investors could come in and take a controlling stake of the company. Now, you will notice that sometimes companies use this word shareholder wealth. Most of the older books in corporate finance, and even some of the new ones, they talk in terms of maximization of shareholder wealth. Um, and sometimes I'm asked, what's the difference between shareholder wealth and shareholder value? Uh, some people use it interchangeably, but what I have seen is when people talk in terms of shareholder wealth, they are talking about the value of a company as of today, as at a particular point in time, shareholder wealth. So, shareholder wealth for a listed company, okay, shareholder wealth for a listed company is similar to market capitalization. Market capitalization of equity. And market capitalization simply means total market value, yeah, of the equity shares. Shareholder wealth. Yeah. But shareholder value, on the other hand, is the present value of future cash flows. Let me give a gap here. Shareholder value, on the other hand, it is the present value of future potential cash flows. Okay? So that is a difference, if you like, between shareholder value and shareholder wealth. Yeah, this shareholder wealth, this shareholder value, sorry, and this is shareholder wealth. Yeah. Nowadays, many people make this distinction. Shareholder wealth, the value of a listed company at any given point in time. Shareholder value, the value today of all the future cash flows that we expect to get, yeah, from the company. So now we have projected cash flows in our little example here. Company A and B are expected to give cash surplus, sustainable cash surplus of about 19 million into the foreseeable future. Yeah, and we assume it that it is going to be a perpetuity, but as long as it is the foreseeable future, it is perpetual enough. Yeah, company C is very exciting. It has higher projected cash flows, but it also has a higher potential volatility of outcome, and therefore the risk is high. And for most part, our definition of risk is this: volatility or uncertainty of an outcome. Yeah, but these are our best estimates. So, what would be the maximum value that someone would pay for a company like this? Well, we would take 19 million and divide it by 10%, and I would get 190 million. So if you were negotiating to buy this company and you were doing your maths, then based on your required return of 10%, the maximum that you would pay for company A would be 190 million. You probably start your negotiation at 100 million and see how eager the other party is to sell. Okay? And company B, similarly, 19 million, but you have to take somewhat bigger risk, isn't it? So you would only be willing to go up to a max of around 158 million. That's all. Yeah. Company C, on the other hand, promises 25 million. There's a good chance that you might get 25 million, but there's also a high risk that you might not see anything at all. And that's why you want a required return higher. If you are going to go into this sector, if you're going to invest in this company, then you must be making really good returns. Yeah. So for this company, company C, even though it has higher returns, you will be willing to pay up to only 125 million from a purely financial point of view. But you must remember that the financial feasibility is the final feasibility in any feasibility analysis. Yeah, feasibility analysis has 3 levels. When you talk about feasibility, MBA perspective, if you like, feasibility has 3 levels, 3 perspectives. The first level is that feasibility should be through the filter of strategy. So whatever we do, whatever project we undertake, whatever new investment we have, it must be strategically feasible. That's the first level, the first filter. Then the second filter is that it must be operationally feasible. So strategic feasibility, operational feasibility, if those two are green, tick, tick, and then we talk about financial feasibility. Can we make money? Yeah. So whenever you are looking at feasibility projects for your company, don't jump into the money straight away. First of all, ask yourself, does this match? Is there a good fit between our current corporate strategy and what we are proposing now? Will there be a good fit? Is that going to be a diversification, or is that going to be more of the same? Yeah. That's the first thing. You have to answer your strategy questions first. Will this bring us closer to our value statements, to our vision and mission? Secondly, then you ask yourself, can we operationally do this or not? Yeah? Do we have the money? Do we have the technical expertise? Do we have the market positioning to do all of this? And if the answer is yes, then you say, okay, now let's see, can we make some serious money out of it or not? Yeah, that's how it works. So, since there are two components, you can see one is projected cash flow. Yeah, this is one component, and the other is required rate of return, isn't it? These are the two components: projected cash flows and required returns. So, a company that wishes to maximize shareholder value should therefore work to maximize projected cash flows, as well as carry out their business in a way where their risk profile would be lower, therefore the required returns would also be lower, where there's some certainty in what they do. Now, how can a company maximize future sustainable cash flows? So this is where what we have studied in other modules of MBA actually comes into play. Yeah, to write your assignment, you will have to bring in everything that you have studied from other MBA modules as well. I have always suggested to you, and I would like to repeat that suggestion this morning, that when you complete your assignment, do not complete the assignment just to finish off this module. You should complete the assignment with a view that this is going to be tangible proof of what you have taken out of the MBA program. It should become living proof and evidence of your best output. Yeah, I have so many students who have used their MBA projects in interviews to really get good jobs. Yeah, and I can tell you there are scores of people like that, scores of stories that I could tell you, where people go for an interview. Of course, they look at your certs and all that, but that's what we call a hygiene factor. Yeah, that's taken care of. Then to see really what you're capable of, the interviewers look at your project papers. Yeah, so you have to take maybe even a bag full of your assignments and project papers and say, see, this is what a project that I was working on. This is what I was working on. Now, usually for an MBA project, you have already taken care about disclosure and things like that. So it's quite okay to share it, yeah, with people. And that is actually what impresses people. That's what will impress companies, big companies, especially to hire higher level managers like yourself. Yeah. Okay, so how can a company maximize future sustainable cash flows? Well, firstly, maximize the NPV of new investments. We will touch base with this good friend of ours, NPV, yeah, net present value. Net present value, if you will remember, is simply a mathematical test to see if a series of projected cash flows gives us a required rate of return or not. Yeah? So when you work out NPV, you are asking the question, can we achieve our required rate of return from our projected cash flows? If NPV is 0, it means that you have just achieved the required rate of return. So if your required returns are 20% and your cash flows are discounted at 20%, and you get all your cash flow adjustments and everything taken into account, discounted at 20% and NPV is zero, then you would say, wow, this project gives me exactly 20%. We want 20%, we get 20%. That's the meaning of NPV zero. So we also say when NPV is zero at this level, because NPV is zero, the projected cash flows give us returns the same as our required returns. The returns from the projected cash flows are called internal rate of return. Yeah, so then we will say the internal rate of return is the same as our required return. But of course, if NPV is positive, it means you get your required return and then some. So a positive NPV represents a surplus return, a return over and above what is required from the share by the shareholders. So this is why we say NPV will add to shareholder value. How? Because NPV, a positive NPV, is actually net addition to your shareholder value by giving shareholders a return over and above what they would require. Yeah, so maximize the NPV of new investments. Why? Because surplus, positive NPV represents a surplus over required return, and therefore an addition to shareholder value. Secondly, you can also maximize future cash flows by continuously optimizing your business. Whatever you are doing, keep doing it better. Yeah, and I have already mentioned this the last time, but I will say it again. A book that you must have, every MBA candidate must have on their shelf, is the Good to Great methodology book. Yeah, let me share with you. Let us see. I believe I did open it yesterday. Yes. To read Jim Collins. Yeah, that's the one. Yeah. Do get this because it costs what? See, got second-hand ebook can buy for 10 ringgit also from Lazada. So if you're the first one to click, you will get it. Yeah. Some 28.85. I think these are second-hand copies, isn't it? Yeah. But anyway, Good to Great, worthwhile. And if you want a brand new copy, a hardcover copy, it will still cost you less than 100 ringgit. Yeah, it's worthwhile. Good to Great, very, very good book. And this book, Good to Great, talks about how you can build shareholder value. Why? Because this is based on the survey of more than 1,000 companies on the stock exchange, New York Stock Exchange, and from that more than 1,000, they found only about 200 plus companies that they classified as good. Yeah, this research group, they found only about 200 that were good. But from that 200, they found only 11 companies that made the jump from good to great. That means they seriously added shareholder value. Yeah, only 11 people did. So it's quite an... Yes?
Sorry, a question here. So you mentioned about the NPV now. So I have seen few examples where the company is doing good and some companies pay out a very good dividend to the shareholders. Okay. So
Yeah.
is it a sign of increasing the shareholder value?
Dividend by itself is not a measure of shareholder value, but it is certainly a reflection of a healthy company. And yeah, I would say that clever companies would want to maintain a good share price and therefore good shareholder value through healthy dividend payments. It's one of the ways, I would say. Yeah.
Okay, thank you, Doctor.
Yeah. So I've just put this here as a reminder to you that in case you have not bought this Good to Great book, please buy it. Yeah. So in Good to Great, they talk about how these 11 companies, first of all, they are comprised of people who know how to work together. So the first rule of Good to Great is first the who, then the what. They say who you have on your team is just as important as what you are doing. Yeah. And not only that, you have to get the right people onto the bus in the right place and wrong people off the bus. Yeah. Might sound a bit harsh, but they say this is what you need to start building a great shareholder value, firstly. Secondly, they say you need to have uh, a brutal approach to accepting the facts that what is good, what is not good, what is rotten in our company, what we need to improve. You need to have some really brutal reality, yeah, in that. So if companies are willing to face up to that, that is very good. But sometimes you find that in many companies, yeah, and all over the world, I have seen there are a bit of apple polishing needs to be done. We need to make the big bosses feel good and happy. Then we won't face the brutal reality, the brutal truth. Yeah. So, but they found that those 11 companies which made the Good to Great leap, actually, they had a very open, frank discussion, and everyone realized that they are human, and everyone parked their egos outside the boardroom when they made good business decisions. And then another interesting concept that they brought in there was the hedgehog concept. The hedgehog is a little animal which is the favorite food for the fox. Yeah. So the hedgehog has certain qualities. Number one, hedgehog knows what they want to do. For example, if they want to build a bridge across a river, the river with flowing water, they don't consider that as a very big impediment, because in business too, we have a flowing river of challenges, yeah, of competition, of changing circumstances, of COVID-19, God knows what else, yeah. But they are at it all the time. And secondly, they have already built in defense mechanisms to make sure that if they need to handle a certain negative turn of events in the market, they know what to do. If they have already met with new competition, they are alert, they are ready, they are prepared. Yeah. And what the hedgehog does is basically, if a fox does catch up with a hedgehog, it curls itself round and it has a very hard outer shell, so it is prepared. I mentioned to you yesterday that I was a part of a panel for Beyond COVID 19, yeah, business resilience. Actually, I've developed a model after looking at all the different cases and all. I will be publishing an article for Wiley. Wiley, the book publisher, they have 3 journals. So one of their journals is the Strategic Management Journal, SMJ. And I'm publishing this next year, but just to give you a peek, basically the model that I have proposed is a SMP model. SMP model is basically this. Because of what COVID has done to the world's economy and economies around little countries and big countries, you have those businesses that have suffered and died. You have some businesses that have flourished. Some perished, some flourished. But there's a fair number of companies that are still just tugging along, maybe in a slightly different size, maybe in a slightly different format, but they are tugging along. And those are the survivors. So my SMP model, the first one is S, that you are a survivor, you're a surviving company. So the first thing you need to do for 2021 is to make sure you survive. Once your survival criteria are there, so there are some suggestions I've made on how you can survive. Then the other thing I have suggested is that you have to maintain your momentum. A certain amount of business momentum must be there. You cannot fire everybody. You cannot sell off all your assets. There must be a certain core momentum. Yeah, just like the hedgehog principle, there must be a certain core momentum that must be going, that still makes commercial sense. Yeah, and the thirdly, most importantly, be prepared for an upturn. Be ready for an upturn. Think positively about an upturn. Yeah, so positive preparation for an upturn. And I think that is what companies should start doing. Even if the upturn comes in 6 months or 1 year or 2 years, just preparing yourself for the upturn will create so much of positive energy in your company that you will find that you might start getting good results. So this is the model that I'm proposing, which will be published next year. Yeah. So good to great methodologies. Then you have, of course, the balanced scorecard, 7S, 7C, management by objectives, just in time, JIT, Kaizen, ongoing improvement. These are all the tools that I think you have studied from time to time in MBA, yeah, which will maximize cash flows from the current business operations. Then you transfer investment from negative spread units to positive spread units. This is taken from Glenn Arnold. Glenn Arnold suggests that you should know what are the strategic business units, SBUs, of your business. And for each strategic business unit, you should be able to establish a required rate of return. Those units, those SBUs, where the required returns are higher than your actual return, they are called negative spread units. Yeah, and those SBUs where the returns are higher than your required returns, then those are positive spread units. So one of the ways to build shareholder value, and many American companies actually practice this, yeah, is that you will move resources from the negative spread unit, so downsize that and give the money to the positive spread units. Yeah, but of course, your positive spread and negative spread should take a long-term view. That's why I defined strategy from our financial strategy perspective. Strategy is about making decisions today that will have an impact on our business from today until the long term. Yeah, so when we move money from a negative spread unit to a positive spread unit, we have to consider from the short term to the long term. Yeah. Then reduce risk, of course, through active risk management. Yeah, we will look at some risk computations, but for this morning's discussion, risk response can be based on, this is part of the COSO framework, by the way, COSO. COSO, just like you have ISO, you have COSO. This is Committee of Sponsoring Organizations. Yeah, COSO. This is the COSO framework. Your risk response can be, well, first of all, if you have certain business risk aspects, first of all, you can try to avoid those situations where insufficient information is available or insufficient assurances are available. Try to avoid that. Yeah. Then what you are going to do, see, are you going to do it by yourself or are you going to do it with partners? So if you are going to do it with partners, that will mean you are going to share some of the profits, but you will also be able to transfer some of your risk through collaboration or underwriting agreements, stuff like that, transfer. Thirdly, eliminate through diversification. Some risk, not all risk, we will see, some risk can be eliminated through diversification, and whatever else remains, you have to manage it on an ongoing basis. Yeah. So you say you mitigate it to reduce it, and that's what hedging is all about. Yeah. Now, then finally, use corporate communication to build a positive risk profile and introduce uh, the expectation of lower returns. So lower the returns, lower the required return. Lower the required return, higher the shareholder value. I mean, this is basic maths. If shareholder value is future sustainable cash flow per annum divided by required return, if future sustainable cash flow is higher, shareholder value will be higher. If required return is lower, then shareholder value will be higher. Yeah, so this is inversely related. And required return will be lower if risk is managed well. Now, maybe we can talk a little bit about risk straight away before we jump into cost of capital and other things. Let's see what I have for risk. Yeah, there you go. Let me just... Any questions so far? All good? We all having a good Saturday morning? Yeah. Okay. Risk classification, first of all. How do we define risk? Well, in corporate finance, all risk is defined as business risk and financial risk. Yeah, business risk and financial risk. All risk. There are two classifications in corporate finance. Financial risk, this one here, financial risk means borrowing risk. That's all. Yeah. So please be very careful about this, because in English language, maybe financial risk means risk of losing money. Yeah. But in corporate finance, that is not it. In corporate finance, financial risk has a very specific meaning, and that is risk of borrowing, financial risk. And business risk is risk of being in business, all other risk, if you like. Yeah. So business risk is risk of business operations. This risk of business operations can come from the market. So then we call it systematic business risk, or it can be the individual risk factors. That means circumstances from within the company itself. Yeah. For example, the quality of raw materials we have, the quality of our supply chain that we have, our location, our positioning, the kind of infrastructure we have internally, the kind of people we are able to attract to our company. All of those things are our internal risk factors. Market risk factors, of course, are external risk factors. Yeah, demand side factors, supply side factors, logistic side factors. All of these things together form your business risk. Financial risk is then a layer of risk over and above your business risk. Every business has business risk because they are in business. But if you are in business and you borrowed money, then there's an additional layer of risk called financial risk, which is borrowing risk. And again, your borrowing risk can be affected by your individual factors, how much you borrowed, what are the terms, what's the tenure, how long you will take to pay back these loans, is it secured or unsecured, that kind of thing. Yeah. And the market risk factors are, of course, things like changes in interest rates or credit policy, ease or difficulty of trying to get a loan. Yeah, all of these things. So this is business risk and financial risk, and of course each one is either from the market or based on individual factors. Now sometimes people like to look at this risk thing from the internal and external risk point of view. Now if we do that, then you could look at risk something like this. If you're looking at total risk, for example, yeah, let us say this is your total risk. Yeah. Okay, Anjani. Total risk is measured using standard deviation. Standard deviation is a measure of total risk. But once companies reach to a level where they can become listed, quite often they already have a group of companies working with them. So they have one entity, the holding company that is listed. We choose one of the companies to be listed, but then we do our business through many other companies. And quite often we are quite well diversified. Now, a company that is well diversified, theoretically anyway, if you are well diversified in at least 11 to 15 different business sectors, yeah, 11 to 15 different sectors. There are so many empirical studies on this. But if you are well diversified in 11 to 15 sectors, then you virtually have no individual risk. The only risk that you are affected by is market risk. Banu, your mic, Banu. Your mic. Can you mute Banu's mic, please? Yeah. Think Banu doesn't realize.
The host can actually mute the participant's mic.
Yeah, I'm going to that. And okay, it's muted now. Okay, that's fine. Okay, back to our story. Yeah. Okay, so total risk is measured using standard deviation. But as I was saying, if companies go for listing, then by the time they go for listing, they are usually well diversified. And we have several studies of empirical studies that show that companies that have diversified into 11 to 15 different business sectors with counter-cyclical cash flows. That's the meaning of diversification, by the way. In corporate finance, diversification doesn't mean just another industry. It must be an industry whose cash flows are somewhat different from yours. Not necessarily opposite, but somewhat different. Yeah, we call that counter-cyclical cash flows. For example, you think about airlines. Yeah, airlines have it bad with COVID-19, but so do hotels. Yeah, and there are many airlines who have invested in hotels. Hotel industry is different. Airlines are different. From a strategy perspective, you might say, well, that is diversification. From a financial perspective, we would say that's a very poor diversification. Why? Because their cash flows are not so counter-cyclical. They are related to each other. Yeah. So airlines, hotels, and tour operators, they may be different companies, but they do not really represent counter-cyclical cash flows. So from a corporate finance point of view, it has to be something like airline and hospital. Yeah, something like this. Yeah, construction and academy, something like this. Yeah, counter-cyclical cash flows. So if you have 11 to 15 different sectors that you are invested in, then your diversification is quite efficient. Now, if that is the case, then most of your unsystematic risk would be taken care of already. You have diversified it away. You can diversify away your unsystematic risk or non-systematic risk. You can diversify away your individual risk, but market risk you cannot diversify away because the market's simply too big. But what happens is this: if we measure total risk as standard deviation, and then this. If I then say that I need a shape format here. Shape fill. Let's give it this fill. Yeah. So let us say that this is the part of risk which is market risk. Yeah. So this is my market risk, and this is my market risk. Market risk, and market risk is measured by using beta value. Okay. Beta value. So now you know the difference between beta value and standard deviation also, I hope. Yeah. Companies that have not yet diversified will be subject to total risk, which will be measured by standard deviation. Most listed companies are quite well diversified, and therefore the only risk that they are subject to is market risk, which is measured using beta value. And we'll come back to beta value and market risk, but just to give you all an overview of risk. There you go. So risk can be business risk or financial risk. So what are the different risk factors? The last time I did this class on a face-to-face basis, we put down some risk factors. Yeah, any event that will cause the business plans to become wrong. For us, that would be a risk factor. Yeah, for example, territorial disputes like China with Vietnam and Manila and every other neighbor. Level of consumer demand, loss of a key customer, manpower supply, utilities disruption, So you can see most risks are actually market business risk, but like a loss of a key customer would be an unsystematic business risk. An example of systematic financial risk would be regulatory changes. Regulatory changes, you will notice, are both business risk as well as they can affect your borrowing, like borrowing rates and the overnight rate policies and things like that. Same thing with tax rate. Tax rate can affect you both ways depending on whether you have borrowed money or not. If you have borrowed money, then this column H is also affected. Yeah. And sometimes if you have borrowed money in a foreign currency, then this affects you a bit more. Does it affect you here? I would imagine it does. Yeah. Interest rate fluctuations, I suppose it would affect you more here rather than in the business area. Yeah. So on and so forth. So anyway, this will be for your reading pleasure. Yeah. And this is my discussion of risk and shareholder value for this morning. I'll take a short break to see if you have any questions. Any questions at all? No questions. Then can I please continue? Yeah. Let me continue then. I want to jump into the very big topic here, and that's cost of capital. Let me introduce the conceptual logic for cost of capital first. Yeah. What do we mean by cost of capital for listed companies? All listed companies who want to invest, well, businesses are investing all the time under good circumstances. Yeah. So listed companies who want to invest need to know what should be the required return from their investment. Should we require a return of 25% or 30% or 15% on our new investments? We need to know what should be the required return. How do we measure that? Well, the concept says if you are a listed company, you can get an expectation of required returns from the people who are investing in your shares and bonds these days. Because people who are investing in your shares these days are the people who reflect that they are happy with the kind of returns that they are getting on the stock market. Yeah. So look to the stock market and ask the stock market what kind of returns would you like, and the stock market has that answer for you already there. In the sense that if you measure the returns that people are getting buying your shares, then you would say that these people are buying these shares because they're happy with these returns. The same thing with the bonds. Yeah. So if I take the returns that we are giving to the market on our shares, and I take the returns that we are giving on our bonds, and I get a weighted average of the two, weighted average based on market values, then I will be able to get what an overall required return would be from the guys who put in long-term money into the company. So we are not talking about the original shareholders who put in their money and now they're probably not looking at it or they have sold it off. We are talking about people who buy and sell our shares and securities and bonds these days on the market. Yeah. So this should be based on current market returns given to providers of long-term finance, and this becomes the basis for computing KO. KO here doesn't mean knockout. Here it means overall cost of capital. Yeah. So KO or K naught, if you like, is the weighted average of market returns on equity as well as debt of listed company. So what we are going to do in the next few minutes is we are going to see what are the mathematical processes for this, and this is directly relevant to your assignment as well. So let's take a 5 minutes washroom break, and then when I come back I am going to jump into this discussion. Yeah, 5 minutes.
Sorry to interrupt. Sorry to interrupt, Professor. I couldn't hear anything, but I can see the
Yeah.
screen.
I think doctor is muted.
Yeah, guys, don't worry. I'm just preparing myself while I give you a 5-minute washroom break. Yeah, don't worry. I'll be back with you in a minute. Okay, welcome back. We're going to spend the rest of the morning talking about cost of capital, yeah? And as I said just now, the concept behind cost of capital is this. If we want to find out as a listed company, what should be the required return, the required rate of return on new investments, we can go out to the market, the stock market, and ask from the stock market what should be the returns. How do we do this? Do we send a questionnaire or something like that? No, we just read the market data. Yeah, so based on the market data of the kind of returns that people are enjoying on our shares, we will say these are the returns to equity. Based on our study of the returns on the bonds that are listed in the market, we would say that this is our cost of debt, yeah, cost of using debt capital. Then we will take a weighted average of the two, the cost of equity and the cost of debt, so that we will then be able to get the required rate of return. And you will remember the required rate of return is actually that which we use to calculate shareholder value. And we said earlier, to maximize shareholder value, you either maximize future potential cash flows per annum or you minimize overall risk exposure. If you are managing your portfolio, your business portfolio well, then the market will require a lower return from the investment in your stocks and shares, yeah, and bonds, because there's a direct relationship between risk and return. When you go into the market for investments, not all investments give you the same return. Different investments give you a different level of return. Now, why is it that sometimes we are willing to accept a lesser return and sometimes we expect a higher return? Well, we are willing to accept a lesser return because our perception of the risk in that investment is that there the risk is lower. Yeah. So when we look in the stock market, if people pay more for a share and effectively they get a lesser return, that is because they feel that this company is a bit more stable. Yeah, it's better. On the assumption, of course, that the market's valuations are correct, yeah, and the market is in equilibrium. There are some underlying assumptions always that take place, in corporate finance, and the underlying assumptions, you should always keep this in mind. Yeah, these are our underlying assumptions. These are always there. So, for example, firstly, it's a perfect capital market. Which is in equilibrium. You have to make this assumption in order to develop a model. Yeah. So the capital market is perfect. Perfect markets, you will remember from your study in economics, are markets where there's freedom of entry and exit. There are very minimal transaction costs. Everyone has access to the same level of information. Yeah. These are the definitions of perfect capital market. And it is in equilibrium. Secondly, rational investors. Investors are rational and they have more or less similar expectations of the future. Yeah. Now, if all these things apply, then we can work out cost of capital. What is capital? Quick reminder. Capital is the long-term finance used to acquire business assets. That's all. Long-term money. Capital means long-term money. Yeah. And what are the sources of long-term money in a business? Well, sources of long-term money are equity capital. That's the money that the shareholders put into the business. So when we want to work out the required returns from equity, when we go to the stock market and measure the returns on our shares, we will call it KE, yeah, cost of equity. And then we will look at the bonds, debt capital, sukuk, whatever, those bonds or loan stock or debentures that are issued. Then we will see what are the market returns on the bonds that we have issued, and we will call that KD, cost of debt. But because interest on these bonds is usually a tax deductible expense, so we will take out the tax benefit. Yeah. So you see, it's KD multiplied by 1 minus T, where T is the tax rate. So we will take the cost of debt. For example, if you pay 10% interest on your bonds, but you get a tax rebate 20% of your expenses, your business expenses, because your tax rate is 20%. So if you pay interest of 10%, you get a rebate of 20% of 10%, which is 2%. The net cost to you is only 8%. That is why the formula is KD multiplied by 1 minus tax rate. So 1 minus tax rate in my example just now would be 1 minus 0.2. My effective cost is only 0.8. Yeah, although I give the providers of debt finance 10% returns, after my tax rebate, my net cost is only 8%. Yeah, that's the KD1 minus tax there. Okay, then cost of capital is computed as a weighted average of the cost of component sources. The weightage is based on market value of shares and bonds or debentures, and the individual cost of equity and cost of debt then can be computed either based on current income to providers of capital or the level of systematic or market risk. Okay, we will look into the details of this in a bit. Yeah, but for now, let us see how we can work out the weighted average. Yeah, and I'm going to put some data on the screen and give you a couple of minutes to try to put this into the formula. So what is the formula for weighted average cost of capital? Here you go. This is the formula. Yeah. cost of capital, overall cost of capital, K0, is the cost of equity, KE, multiplied by the proportionate value of equity plus cost of debt after our tax benefit, of course, multiplied by the proportionate value of debt. I will do this for company A, and then maybe you can just practice it a few times for B, C, D, and E. You will need this, of course, for your assignment. Yeah. So I hope you have your notebooks and your calculators and everything close by. Let us look at the data for A. We are told that for company A, the cost of equity is 15%. So when we went to the stock market and we saw what kind of returns our shares are giving, we got it for company A as 15%. Company B is 25, C is 18, so on and so forth. Cost of debt before the tax benefit was 5%. Rate of tax is 20%. So what's 20% of 5%? 1%. So what will be the net of tax cost to this company? It will be 4%. 5% minus the 1% tax rebate. Yeah. Then we are told that this company has 80 million shares. These are all the number of shares. Yeah. 80 million shares. The price per share is 5. So what is the total market value here? 80 times 5 is 400 million. Yeah. So their equity is 400 million. Their bonds are 200 million. I've already given you the value. So from there you can get the weightage, the proportionate value of equity, which will be 400 over 600. And for the bonds, it will be 200 over the 600. Effectively 2/3, 1/3, isn't it? Yeah. So if I was to put all this data in a working schedule like this, that's it. There are 8 steps here, and every time we work out these 8 steps, we will get our cost of capital. Very simple. It's a very technical, very mechanical computation, and all you need to do is, the big challenge for us in practice is actually to get the data. The formula itself is pretty simple. Yeah. So to compute or determine the total value of equity, we said just now, number of shares is 80 million. So you would say 80 million shares. Let me just take this out of it. And you would say equity E in my formula, if I call it E, yeah, is number of shares, 80 million shares, 80 million shares at RM5 each. Would give me 400 RM million. Yeah. And the bonds as given, $200 million, again RM million. So that the total, if I said, yeah, if V is equal to total market value of equity plus total market value of bonds, and that would be equal to 600, isn't it? 600 RM million. So therefore, the proportionate value of equity, yeah, in this case would be 400 divided by 600, which is 2/3, or 0.67. Yeah, and see, 400 divided by 600, 0.67 proportion. Yeah, proportionate value of debt would be 200 divided by 600, which is basically 1/3, or we would say 0.33333. Yeah. Again, if I ask Excel to do it for me, 200 divided by 600, 0.33. So now I know what's the total market value. and I know the proportionate value of this. So we can say 0.67 or 2/3 of company A is equity, 1/3 is bonds. Now we want to know what are the returns on equity and what are the returns on the bonds. Yeah. We normally would need to compute KE, but since this is an opening example, I have given you already the returns on equity is given equal to, let's see, 15%. There you go, 15%. Yeah. %. And the cost of debt net of tax benefit, we said just now, get a tax rebate of 20% or 5%, which is 1%. So that would be equal to 5% multiplied by 1 minus 0.2, just to write it in a complete way. And that is equal to 5% multiplied by 0.8 is equal to 4%. Yeah. So once we get that, then we can substitute all of this in the formula, and we can say K naught is equal to a proportionate value, KE multiplied by proportionate value of equity, isn't it? So that would be KE is 15% multiplied by 2/3 or 0.67 if you like. And please remember, we got this proportionate value as E divided by E plus D. Yeah? That you need to remember when you talk about capital structure theories. Plus KD net of tax which is 4% multiplied by 1/3 or 0.33. Yeah, those brackets, and we should get a certain answer here. Well, let me see. I did this 15 multiplied by 0.67 plus, if I use the formula here, then there's no rounding up, yeah? So because Excel will calculate the full thing, plus 4%, the cost of debt after the tax benefit, multiplied by the proportionate value. So you see, the formula has 4 key values that you want to find out: proportion of equity, proportion of debt, which you will use to get the weighted average of the returns on equity and returns on debt or bonds. Yeah, and the answer in this case happens to be 11.3%. 11.3%. Any questions at all? No questions. That's brilliant. Okay. Can I now ask you to spend the next few minutes to try to work out the cost of capital for B, C, D, and shall we give ourselves, say, about 8 minutes to do that? Yeah. Have a go. Okay, I'm going to start keying in the data. And I have already captured the cost of debt for each company here. You see the cost of debt of bonds. Before the tax benefit, it is 5%, 6%, 7, 6.5, sorry. So I've captured that here. And I've already made the adjustment for the tax benefit. And so I have already formatted this cell to work out the cost of capital in each given circumstance. Yeah. So yeah, this fits in just nicely. So for company B, number of shares 50 million. So I would say 50 million shares multiplied by 6 ringgit per share. Value of equity E is 300. Let me do mass production here. So company C, number of shares 60 multiplied by price per share 7. Total market value of equity 420. This is also called market cap, by the way. Market capitalization. Yeah, is another word for total market value of equity. And then company D is 30 million shares multiplied by 8 ringgit. This gives you 240. And this is 45 million shares here for company E. 45 million shares multiplied by 9 ringgit per share. Maybe I should label this as RM, isn't it? So that people know. Yeah, there you go. Okay, so that's equity. Bonds, well, the market value of bonds is given 100, 100, 100, 150. So that's easy enough. 100, 100, 100, and this 150. So I can get the proportionate value. And I often say to people, do the easy thing first. Even if you are required by assignment to go into the open market and do this, do the easy thing first. Now you may find the information on bonds is not so easily available, not so publicly available, because you and I can't go and just buy bonds on the market like we buy shares. We usually invest in bonds through our unit trust or through our investment fund. So a lot of this information is sometimes not so readily available. The last time we had this kind of assignment, people asked, can we also use medium to long-term bonds? And I said, yes, to make life a little interesting, just go ahead. Use medium-term as well as long-term bonds. Yeah. So that you get a substantial value of D. Yeah, that makes the calculation a bit prettier. Okay, then I can get proportionate value of equity. Proportionate value of equity would be equity divided by equity plus debt, isn't it? So that would be equal to 300 divided by, in brackets, 300 plus 100. That's how it works. Equity divided by equity plus debt will give you the proportionate value of equity, which is 0.75. Yeah, and don't look at K naught first. Yeah, the proportionate value of equity here, one more time, would be equal to 420 divided by, in brackets, 420 plus 100, which should give me 0.81. Wonder why this is not in the center. Maybe what I can do is this. There you go. These are all the proportionate values. Oh dear, it's a really big one, this one. Okay, I will later make an adjustment for that and make it prettier. The same thing for debt. If equity is 0.75, then debt would be 100 divided by 400. And how do I know it's 400? Because it's 300 plus 100 here. That will give you 0.25, of course. And if I did the same thing here, I would get my values for debt. Now, when I substitute this in the formula for K0, so you see here, sorry, when I substitute this here, so this is what I'm doing really here. 25% is, of course, the cost of equity, 25, and 3.75 is the cost of debt that I worked out, net of tax. Yeah, and I should get something like this, I think. Anyone have questions on this? Do you get similar answers?
Yeah, I got it almost, doctor, but the net of tax is very confusing. So maybe you can explain.
Doctor, I think the E value for company B is not 300, isn't it?
Oh, okay, wait, I check. 50 multiplied by 60, yeah? E value, equity, is it? For which company? Company E.
B for Bangkok.
B, yeah. Okay, B Bangkok. Number of shares is 50. 50 million shares. Price per share 60.
That's correct.
Looks okay to me.
Okay, so apologies.
Sorry? Was there a question?
Yes,
okay.
Correct, doctor.
Correct, yeah? Okay. Okay, so now what is this 1 minus T tax? So it's very simple. You see, here cost of debt was 5%, right? So 5%, 1, 2, 3, 4, 5. Let us say this is my cost of debt, 5%. Yeah, we pay to people 5%. Then our tax rate is 20%, so we are going to get a tax rebate, you know. Our tax rebate is based on our tax rate. So we are going to get a tax rebate of 20% of 5%. Yeah, is 1%. Yeah, if the total cost here is 5%, if I say the total cost here is 5%, interest paid to bonds. 5% interest paid to bond. 20% of 5% is 1%. So the net of tax cost would be equal to 5% minus the 1%, which is 4%. And now mathematically, we can write that as 5% multiplied by 1 minus the tax rate. So we take out the tax rebate, 20%. What we pay is the balance, which is 80%, yeah? So 0.2.
Sorry, doctor, how do you get 1% actually? 20 of 5% equal 1%.
Yeah.
How do you do that?
20% is 1/5 lah.
Or 1/5.
Isn't it?
So you get 20 divided by 5.
Or if you want, you can make 20% as a decimal. You see what I did here? 0.2. Then yeah, 0.2 of 5% is 1%.
Okay, thanks.
Welcome. So then 5% multiplied by 1. 1 here is a decimal for 100%. Yeah. Whenever you decimalize, 100% is 1. So 1 minus the 0.2, which is the 20% tax rate, then I will get 4%. So you see, that was for the first company, isn't it? For the first company, company A. Company B, the tax rate is 25%, so their rebate will be more. So where tax rate is 25%, so your rebate also will be 25%, obviously. Then your cost of debt after tax, 1 minus T, will actually become 5% multiplied by 1 minus 0.25 now, because the tax rate is 25%. So you're going to get a 25% savings on your tax. And that's why the net result will now be 3.75. Yeah, 3.75. That is why two professors, Modigliani and Miller, they say the more interest you pay, the more tax you will save. And therefore, greater will be the value of the company. Yeah, well, their theory has been questioned and challenged, but basically that's what they have been saying here. We will test their theory too. Are we okay with this?
Doctor.
Yeah.
The 1% say 20% divided by 5%.
Not divide. 20% multiplied by 5. 20% off, yeah. So from this 5%, if you just take 20%, 1/5 of it.
Oh, okay, understood. Okay.
Multiply. So maybe if I did this, 1, 2, 3, 4, 5. 5%. Yeah, this is interest paid. But this particular cell is the tax rebate. Cell bill. There's a pattern now. Side R. Say this one. Okay. So actually the total paid is 5%. Yeah. 5% interest paid. 1% the shaded area is the tax rebate. So the net cost is 4%. Yeah. The cost becomes is 5% minus 1%, yeah, which is 4%. And where did we get that 1% from? As you quite correctly asked me, 1% is based on the tax rate. So if the tax we pay is 20%, then we take off 20% from your cost, because this is a tax deductible expense. So on this 5% interest that you have paid, you won't be paying any tax. Yeah, you will save tax. How much? 20% of 5%, which is 1%. If I pay 10% interest and my tax rate is 20%, I'll take off the 2%. So my net cost will always be 80% of my business expenses. So you can say, as a general rule, if a company pays tax and if the effective tax rate is 20%, then for all the business expenses that it has charged, the effective net of tax cost is only 80%. Because you're going to get a tax rebate on this. It's a business expense. Here, if it is 25, the net of tax cost to you is 0.75, 75%. Here it is 0.7. Here's 0.8 again. Here's 0.7. Yeah. Because you pay $1, you get 30 cents rebate. So your net cost is 70 cents. Everybody okay with that now?
Yes.
All good? Okay,
Good.
Excellent. Okay, so now let's move on to something a little more involved. In this example, my starting example, I gave you straight away cost of equity, KE, is 15%. I straight away told you returns on debt, 5%. Now, please note, in the market, we call it return on equity. But now, because we are talking about it from the company's point of view, we call it cost of equity. Yeah, but it's the same thing. Returns on equity in the stock market is cost of equity for the company because they are paying these returns. Returns on the bonds in the stock market is the same thing as cost of debt for the company because the company is paying these returns. Yeah. Okay. Now, how do we calculate these?
Sorry to interrupt. How do you get, for example, in real cases, cost of equity 15%? How did you actually derive this formula?
Okay, I'll show you now. Yeah.
Sir, can
Let's
I
say
ask
for
a question?
cost of equity is how we're going to do the next stage. Yeah. There you go. Computing the cost of equity and cost of debt. See, I know you're going to ask me that question. Yeah, I have it here.
Okay.
Cost of equity is, of course, KE, is the required return by providers of equity finance. Cost of debt is KD. Just remember the KE, KD. Yeah? So when we talk about KE, we are talking about return on equity shares. When we talk about KD, we are talking about return on the bonds. Now, before we jump into that, let me introduce you to a theory. This is portfolio theory. Yeah. Now, before portfolio theory came along, portfolio theory was initially discussed by a fellow called Markowitz. So, Markowitz has written a lot on portfolio theory, and from portfolio theory, he derived also a market model, which was called the Markowitz model, later became the capital asset pricing model. Yeah. So, anyway, portfolio theory is a theory which says that when you are considering new investment, most people will consider risk and return only. Yeah, how much risk do I have in this project? What kind of returns can I get for the level of risk that I take? And for quite a while, many people said risk return, but somehow their decisions were not so accurate. And then those guys who were studying the stock market, they said, well, that's because you did not consider your existing position. You did not consider where you are today. If I have a certain business, let us say a series of restaurants, and now I want to set up maybe a fancy restaurant or something like that, fine dining restaurant, I want to know what is the risk of setting up the fine dining restaurant. I want to know the return, but I also want to know what is the risk relationship of that fine dining restaurant to my existing business portfolio. So, portfolio theory says that when you take on new investments, you must also consider what your existing portfolio is and what will be the risk relationship of the new investment with your existing portfolio, and hence the word portfolio theory. So all business units can be considered as components of portfolio. The way the theory was developed was that your existing business is considered as one asset and your new investment will be the second asset. So we developed what we call a two asset portfolio theory model. Yeah, two asset. The existing business portfolio one, the new project being the second one. And what were the findings of this portfolio theory? Well, the findings of portfolio theory were that if you want to maximize the returns, then investment should be focused on trying to combine all your strategic business units which give you the highest returns. Yeah, so something that gives you 25%, something 45%, something 60%. When you combine them, you will get overall weighted average returns that are the highest. But to minimize the risk, you cannot minimize risk by simply taking the low risk investments. Why? Because sometimes the low risk investments, let us say, we have investments which have a risk profile of maybe only 12% risk, standard deviation, yeah, 12% risk. That means 12% fluctuation from our expected outcomes. I combine it with another 12%, another 12%, but all the projects that I take are almost identical to each other. Then I won't actually minimize my risk. However, if I take projects where one is 12%, one is 14%, maybe one is even 15%, but they are not exactly like each other. They are slightly different. That means they have what we call a correlation that is less than 1. Now, if two variables is a big mathematical word, but variable simply means any market data or market information. Yeah, if we have two variables that are perfectly related to each other, that means identical. Think of it as two identical businesses. If I combine two identical businesses, I have not achieved diversification. Yeah, I have not achieved diversification. If I combine two identical businesses, no diversification is achieved. But if I combine two businesses that are slightly different, then we will say their correlation is less than 1. This is called the coefficient correlation. It's a measure of relationship. In mathematics, yeah. In life, maybe love is a measure of relationship. I don't know. But in maths, coefficient of correlation, yeah, is a measure of relationship. And any two things can be related to each other up to 100% only. I mean, you can't have 110% relationship. I cannot have 110% relationship with my parents. I'm only 100% related to them. Any relationship is just 100%. So if two business units or if two investments behave exactly the same under the same market conditions, then we will say their coefficient of correlation is 1. Meaning to say they are 100% the same as each other. 100%, yeah. So coefficient of correlation is a measure of relationship. So if coefficient of correlation, let's say AB is equal to 1.0, which is again a decimal of 100%, then we will say this is perfect positive correlation. That means you can totally predict the change in one variable, one business unit, based on what you observe on the other. Yeah, perfect positive correlation. But if coefficient of correlation is -1, -1, this is perfect negative correlation. That means if one goes up 10%, the other will go down 10%. Yeah? And of course, these are the two extremes of coefficient of correlation. Yeah, these are the two extremes. Most values lie in between this. In fact, most values in life are generally positive correlation, because in life, most things are correlated. But if you're lucky, you might actually find businesses that actually behave differently under the same market conditions. Some businesses do better in a recession. Some businesses do better in a boom time. And if you can mix these two businesses together, that is amazing. For example, I often quote the example of Goodyear, which is a very easy to understand example. Goodyear manufactured tires. After some time, they realized that the sales of tires, the volume, during not so good times goes down. Most of their commercial clients wouldn't buy new tires. They would buy retreads. So they started balancing their business portfolio such that when the economic conditions were down, when there was recession, they would focus more on selling retreads, because retreads would become more popular. And when times were good, they would focus more on selling new tires, and they would promote new tires and give promotions and things like that on that. So that way, they understood the coefficient of correlation between new tires and retreads was a negative correlation. Retreads do better. I think what we call in Malaysia celop, yeah, tire celop, were better during recession. Retreads were better during recession, and fresh tires, new tires were better during normal economic times or good economic times. So this is how the coefficient of correlation helps you or provides mathematical evidence that diversification will help you to remove individual risk. Okay, you might say, well, I knew that intuitively. Yeah, but this one is mathematical proof that actually when you diversify, when you invest in investments which have counter-cyclical cash flows, yeah, investment in business assets or units that have counter-cyclical cash flows is diversification. So this is the definition of diversification, yeah, from a corporate finance point of view. Investment in business assets or units that have counter-cyclical cash flows is diversification. Portfolio theory provides mathematical evidence that diversification can reduce or even eliminate, almost I would think, eliminate individual risk. So as we said earlier, most listed companies are already well diversified. They already have a well diversified portfolio. Therefore, when you want to look at the business portfolio and ask yourself, what kind of returns should this business portfolio give us? We don't need to look at the entire portfolio itself, or we don't need to look at the standard deviation of the risk of the portfolio. We only ask ourselves, how will this company's business be impacted by market conditions? Now, how do we measure the risk by market conditions? We measure it using beta value. Yeah. So to take the logic from the top, to maximize returns, investments must focus on those business units that give you the best returns. to minimize risk, you should combine your business units such that they have either low positive correlation or negative correlation, because low correlation or negative correlation means your cash flows are going to be counter-cyclical, and therefore there is diversification. Listed companies are expected to be efficient in risk management, and so therefore they should already have diversified portfolios. And therefore, the only risk for which your shareholders will require compensation for will be market risk. So all that we need to take into account when we work out the required returns from equity for our cost of capital will be returns based on market risk. Now, the measure for market risk is beta value, and the model that takes the market risk and gives us a required return based on market risk is called the capital asset pricing model. Yeah, the capital asset pricing model. And this is what we are going to be talking about at 2 p.m. So, any question?
Doctor. Hello?
Yes, go ahead.
In the context of bond, cost of bond, is the coupon rate, is it after tax rate of return on bond or before?
No, it's before. Coupon rate is the actual interest you pay. So our after tax cost is coupon rate multiplied by 1 minus the tax rate.
Okay.
So coupon rate is
in
a
Malaysia, so we have to do it like 1 minus 24%, right?
Yeah, you could do that. Yeah.
Okay, thank you.
Any other question?
Yes, Dr. Harvey. So, in terms of the sharing that you have done just now, the calculation is analyzed in terms of the returns of capital, meaning that I'm not sure whether my understanding is correct, so I'm just going to share with you my thoughts. So, meaning that the cost of equity plus cost of debt, these two types are the source of funding that the company has actually acquired. And so this calculation is to understand in terms of the proportion from equity and proportion from debts, that's what is proportion rate multiplied by the rate of returns to get you the value, the real value of returns for this whole entire source of funding. Am I right?
Yes, perfect. That is therefore
thank you.
the overall cost of long-term money for this company. Yep.
All right. Thank
exactly
you so much.
That. You are spot on.
Thank you. Actually, this corporate finance helps to understand further in terms how we apply for the FAM, because
they're actually they're actually like two parts of the same pot, if you like. Yeah.
All right. Thank you so much.
Welcome. Any other questions? Other than, can we have our lunch break now? Might be brunch for some people, I think. If you rolled out of bed and straight into this class, then you probably had time for brunch now. I'm seeing you back at 2 p.m. Am I right?
Yes.
2 p.m. Yeah?
Yeah.
So please get in on time, 2 p.m. Then I'll show you how the capital asset pricing model works. And then by today, you will become certified experts in calculating cost of capital. Yeah.
Certified by Dr. Harvey.
Yes. Indeed. Yeah. Okay. Thank you, and have a good break. See you back at 2 p.m. Yeah.
Okay. Thank you, Doctor. Thank you.
Thank you.
Thank you, Doctor.
Thank you very much.
Thank you, Doctor.
Thank you.